We've had a nice bounce in markets over the past week, and investors seem to be looking past some of the risks that are still out there. Risks such as Japan, such as sovereign debt problems in Europe, and such as the troubles we're seeing in the Middle East at the moment. Are we looking at a resumption of the bull trend in equity markets at this stage?
Yeah, we believe that if you look at equity markets, they're still reasonably priced. They're still priced for some real returns going forward. So we believe the underlying trend in equities should still be up. But as you have said, I mean, equity markets have been hit by the earthquake and tsunami in Japan, the problems in the Middle East, and all sorts of other things. But I think confirmation that the world economy is still growing, that companies are still making more profits, that is providing the underlying support for equity markets and should going forward as well.
Well, what do you see as the risks for this upward trend we're seeing in the markets going forward? What are the biggest risks there?
The biggest risk, funnily enough, we don't view as what people have been worrying about over the last 2 weeks or so in terms of those natural disasters and the unrest that we're seeing. We believe that if you look at the world, sooner or later, we all know that interest rates have to increase. We all know that government fiscal deficits have to be reduced. And that transition from a world economy that is still running on a fair dose of steroids, taking that economy off the steroids and sustaining that growth going forward, that transition, I think, is one of the major risks when we look into the balance of this year and into 2012.
How do you think equity markets will react when we finally do see this loose monetary policy coming to an end, and when we do see monetary tightening globally, particularly in Europe and in the United States? How are equities going to respond to that?
We believe it will all depend on the timing of increasing the interest rates. If interest rates are increasing at a time where the underlying economic growth has become more sustainable on its own, therefore it can get on without very low interest rates, then we think markets should handle the higher interest rates in a better fashion. But if they tighten too quickly in terms of central banks internationally, and this derails the economic upswing, kills corporate profits, then I think markets can react very negatively. So it's really judging the timing of the central banks and government in tightening policy, and that is going to be the major call for the next 12 to 18 months.
Well, we've already had a warning from the ECB that it could raise rates as early as next month. That's its April meeting. Do you think that the US is really key here, and also the speed of interest rate increases, whether we have them in rapid succession?
Yes, the ECB has given a very clear signal. We fear that they might be a little bit too early in the cycle. The same in the UK. If we look at the central bank voting at the Bank of England, it's more and more votes are coming up for possibly a hike in interest rates. That's still a very weak economy. There, the timing could be perhaps, or the risk is that the timing is that they're too early. If we look at the US and we look at the Fed statement that came out again recently, they appear to be more patient. They appear to be waiting for the economic upswing to be more sustainable, possibly more willing to run a risk with higher inflation than Europe at this stage.
How about here in South Africa? We're still within our inflation targets, unlike the ECB and unlike the Bank of England. But there are still some inflation risks out there, and they have been outlined by the Central Bank Governor Jill Marcus yesterday when she gave that press conference. So there are some risks to the inflation outlook in South Africa also.
Absolutely. I mean, we suffer from the same commodity price increases that we're seeing pushing up inflation rates all over the world, be that energy prices and food prices and also other commodity prices. However, in South Africa, the worrying factor is that these commodity price increases that we're seeing can easily spill over into other price increases, those so-called second round effects, because wage increases in South Africa are still very high. If we look back at the economic recession that we had and we look at the wage increases on balance that were still awarded in this economy, it certainly would suggest that inflation risks are high in South Africa, and the continuation of the sharp revival that we've seen in consumer spending, it's been growing at an annual rate over the last 4 quarters of about 5%. that would certainly increase those risks, and the scenario of rapid and big interest rate increases over the next 2 years in South Africa cannot be totally discarded.
How then do you position yourself, just given the inflation and the interest rate outlook, how do you position yourself in the interest rate market globally and in South Africa?
We believe globally one should still avoid government bonds. If you look at government bonds, for example, it is still discounting a 50% chance of deflation internationally. We don't think that is a realistic assessment of future scenarios. If you look at your other option, if you look at credit spreads available out there, they've narrowed tremendously. High yield bond spreads and those things don't offer any value either. So you find yourself internationally in a very funny situation that you probably would have to stick to cash or very near cash. That doesn't really provide you with any return, but that's because the alternatives are very risky. However, if you look at South Africa, I mean, our bond yields are now in the region of between 8.5% and 9%. That does provide you with some margin of safety in terms of future inflation. So in South Africa, we believe you can hold some bonds, but it's not the time yet to be fully invested in bonds in South Africa.
David, are our equity market valuations starting to look a little more attractive versus developed market equities?
South Africa's equity market is probably on balance still not cheap enough relative to the international markets. If you look at, for example, emerging markets as a whole, we are part of that category. One finds that there's no real discount for investing in these markets, and I would include South Africa in that relative to the developed markets. And recent developments internationally have shown that those emerging markets do need to trade at some discount to developed markets to be an attractive investment. Those developments that I talk about would be the increases in inflation rates and interest rates that we've seen in many of those markets, and the ones coming up in South Africa as well as the problems that have been experienced in North Africa and the Middle East. It shows that many of these emerging markets are still politically fragile. So we still find ourselves that if you look at an equity portfolio, we would still overweight the developed markets relative to the emerging markets and relative to South Africa to some extent.
And what sorts of discount would you expect to see markets like South Africa trading on compared to developed markets before you would start to park fresh money in the South African equity market?
We believe a discount of about 20%. That's a fair discount. That would give you that kind of margin of safety in terms of the volatility of these markets as well, also relative to the developed markets.